Cardinals and the Astros had 10 years or so ago. I've had a conversation with my son recently, who's a sports nut, obviously a Cardinal fan, about the whole sign stealing scandal, which, by the way, the lead in the local news this morning, as I'm sitting in the hotel, was how brutally cold it's going to be here tomorrow, something like 50 degrees. Boo-hoo for you guys. And it was Altuve getting hit by that pitch in the spring training game. And my son's response to this, as a 10-year-old, my son's response to the sign stealing issue was, what does it matter if they knew a pitch was coming, they still have to hit it? Which I think is a pretty You're not off the hook. It's a pretty good comment, though, right? And that rings true for me. Maybe a little bit, you can tell by the title of this presentation. It rings true for me a little bit when we think about what's going on in the markets today, because there's lots of information that we as investors have to digest. There is tons of information equivalent to knowing the sign or knowing the pitch that's coming. There's tons of information that gives us an advantage as an investor in terms of making decisions. You still have to hit the pitch. In that case, it means the markets are still going to do what the markets do. You are not going to bat 1,000 as an investor. But what we endeavor to do, and the way we've instructed our investment philosophy, and the way that we think about investing for long-term goals, is we try to base our decisions on the things that we know give us the best advantage over long periods of time. That's a signal versus everything else that we would consider to be noise. And it's the noise that makes the markets go up and down day to day. It's the signals that tend to drive things over longer periods of time. Tougher to separate those two some days, right? Today, yesterday, things have changed a little bit, at least they feel like they have. I think this is a good example of how emotions tend to work in an asymmetric way for investors. On the way up, we're all happy. And on the way down, it feels way worse than the last 1,500 points up, right? So giving back these 1,500 points in the Dow in the last 2 days has not felt the same as when we got it over the course of earlier in 2020. So we're going to talk a little bit about that. My son is a big golfer, and his golf coach, which working with a 10-year-old in golf, his attention span of a gnat, his golf coach always says, what did you hope to get from that? That's the line I hear him tell his coach all the time. What did you hope to get from that? So today, what do you hope to get from this? So my thought would be we'll spend a little bit of time, and I think I have about 40 minutes with you, so thank you guys for the time today. Spend a little bit of time, I'll just walk through, I'll give you maybe 4 or 5 what I would consider to be seminal charts or some data that we can look at. And part of this is going to be talking a bit about the signals, the things that we do think are going to dictate where the markets go over longer periods of time. I'd also love, in terms of what I hope to get from this, I'd love to hear from you. So we can use the latter part of our time together to take any and all questions. There's nothing off limits in this room, I suspect. So any questions that you might have, I'd love to hear from you on. I've had a conversation with a few about the pulse of the economy in the local area. That's always useful for me as we're trying to piece together the mosaic of what's going on in the economy and the markets. So let's start, and I apologize, forgive me for those of you in the back if this is hard to see. Start with a broader view. We just closed out the last decade. We don't invest in nice, tidy 1-year and 10-year increments. Everybody in here can attest to that. But it is a nice opportunity to bookend things and take stock, no pun intended, of what we've seen in the markets over time. So this is just looking at returns going back over the decades, all the way back to the 50s on the left-hand side, up through the 2010s that we just finished. The green bar is the total return for the stock market. The yellow dot is the average interest rate during that decade. We could easily spend an hour on this chart alone. But just think about, as you visually look at that, what are some of the takeaways you might have? So far right bar, most recent one, you'll notice a really good decade. We are in the middle of the second best and second longest bull market in history. That's what it looks like in terms of over that decade span. So it's still fourth going back to the 50s. We had to put another green bar up on the end of that for the 2020s. Where do you think it's going to be? Bigger or smaller than that 250% green bar that we just finished? What's your guess? Smaller. Smaller? I think so. Part of what drove that bar to get there is that this was the only decade, the 2010s, was the only decade in history that did not have a recession. So, fun fact. Will we repeat that? Highly unlikely. I think almost zero chance that we're going to go another 10 years without a recession. So that's going to play into this, and that feeds into our conversation about signal. What about the yellow dots? Rates staying low forever? I think they've gone lower for longer than most of us ever would have anticipated. I'll speak for myself. We expected rates to go low. We expected them to stay there. They've done so for a really, really long period of time and probably aren't going anywhere anytime soon. But I think it's reasonable that we could see the yellow dot a little higher and probably the green bar a little lower. Now, there's a forecast. It's over 10 years. You can bet darn sure it's not going to be exactly right. It's an interesting stat. Anybody know, if you go back over the past 100 years, what's the average annual return for the stock market? 100 years. About 9.5%. You know how many years during that period the stock market returned 9.5%? Zero. And only one time will you find that it actually was between 9 and 10. So, the stock market gives us 9.5%, and the stock market never gives us 9.5%, right? Because it's a law of averages and everything's swinging around. So what we want to try to process is, what are those swings going to look like as we move forward? It's interesting because you can think about some key characteristics as we look just at this chart. So the 50s, the biggest run in the market over a decade span. Biggest return, 50s. Think about what that era was defined by. That was post-war industrialization, right? The Industrial Revolution, so to speak, almost the second Industrial Revolution that powered our economy. Then we go to the 60s. That was kind of the rise of consumerism that sped off of that industrialization. It also had war. It also had recessions within it. We get to the 70s, then we're talking about low growth to no growth and really high inflation, which defined that period. So you can see high yellow dot, really low returns from stocks. Led into the 80s. Now it's the rise of the consumer again in a much different way. So think moving to suburbia, getting a house, getting a picket fence, getting your dog and your 2.5 kids, which powered that, which then bled into the 90s. Productivity gains, the rise of the internet, all that came with that in terms of benefits to the labor force and capital productivity. We're missing a bar in the 2000s. So you think about the bookends of a decade. Started with tech bubble popping, 9/11, ended with financial crisis. So you'll know there's an absent bar in the 2000s because the return of the stock market was actually slightly negative over that 10-year window. Now, if you slide the scale around, it actually turns positive. It just goes to speak to you the idea. The timing on this, and then we get to the 2010s. How would you define this last 10 years? As a consumer, as an investor? Well, I define it as really slow growth, steadily positive growth, fully defined by the new era of central banking. Put a different way, really low interest rates and tons of stimulus from central banks around the world. That defined the last 10 years. Okay, more than you wanted to know, but that sets the backdrop for where we think we're going to go from here. So this is just that last 10 years. Here's our bull market that we've all been enjoying and living in for the last 10 years. As I mentioned, the second longest, second strongest in history. A couple things to think about. One, there's not a lot of gyration. So this is if you can see this lower left-hand side, that was the tail end of the financial crisis. And on March 9th, 2009, it starts our bull market. It runs up. And you won't see a whole lot of gyrations. This one might catch your eye. So this was the end of 2018. Do you remember what you were doing at the end of 2018? Remember what the stock market was doing at the end of 2018? That part we all remember. Beyond that, and there was a pullback in 2011 when we were talking about Greece at the dinner table and how much debt Greece had and what a problem that was going to be for the rest of the world. Outside of those two periods, it's been a rather steady run for the markets. And the question is, how long does it continue? How long can it continue? At some point, does it just run out of steam because it's been going on for too long? And this will bring us back to that conversation about signal and noise. So let's talk about a couple signals. And we'll start with, I'll give you this chart because this chart is telling for a whole host of reasons. So this is just chronicling prior economic expansions. Think about an economic expansion as the time the economy grows in between recessions. And you can see this dark line is the current one that we're in. Longest in history, by the way, as we talked about before, first decade in history that didn't have a recession. This is the longest economic expansion in history. So the bar is going further right than you can see. However, it is not even close to one of the strongest. And the reason why I say this chart is so interesting is there are really three signals that we want to watch as an investor. Again, if we're thinking about getting the pitch tipped to us, or knowing what the pitch is going to be, the three things that we know invariably are going to drive the success of the stock market over long periods of time are the economy, corporate profits, and interest rates. There's a lot of other factors that swirl around. There's a lot of things that influence those three things. But at the end of the day, if you get those three factors right in terms of their direction, you'll generally have a sense for which direction the stock market is going to go. So that's our signal. And then we got to try to process the noise inside of it. The reason why this chart is so interesting to me is because not only is this the longest economic expansion, it is one of the slowest. In fact, we are not even back to the average level of economic growth that you see in any expansion. Forget how long it lasts. We're not even back to average, and it's been going on for 11 years, which is really telling. So is that a good thing or a bad thing? The economy's been growing at just above 2% for the last 11 years, on average. Good or bad? How do you feel every day as a consumer, as a business owner? Okay? So the reason why I would contend this has been a good thing, is the reason that this line is so long is because this line is so low. Why does that matter? So, think about some of these other economic expansions. So this expansion, the best one in terms of aggregate growth, was through the 60s. A couple spring chickens in this room. So in the 60s, how did that end? What did the 60s bring us in the 70s? Inflation. The steeper the line, the bigger chance we have for inflation. Why? So think about how an economy works. You come out of a downturn, people start to get a job, businesses start to invest, a little bit of economic momentum happens. We spend, businesses invest. People spend more, businesses invest more to meet that demand. And it's a virtuous cycle. And then eventually, we as consumers start to feel really good and really confident, right? And so we're armed with a job, our incomes are going up, and we have confidence. And so we are Americans, what do we do with our money? We spend it. And as the more confident we get, the more we're willing to pay a little bit more and a little bit more for stuff. And that is the definition of inflation. So, the steeper the line, the more robust, the more overheated the economy becomes, the more likely we are to overpay for things. Inflation rises. What happens when inflation rises? Somebody comes to turn the music off in the party. The Fed. So the Fed's role in this world is to ensure that inflation remains stable. Not that there's no inflation. No inflation is actually a bad thing. But definitely not that there's too much inflation. To maintain kind of a 2-ish% inflation rate. So as the economy becomes more heated and inflation picks up, the Fed comes down and turns the music off. And that's what we've been able to avoid for the last 11 years. So the flip side of having a slow, kind of steadily growing economy is that it hasn't been so robust that it's been stoking inflation. And the good news for that, if we're thinking about what that means as a signal, the good news is, to the extent that that continues to be the case, which we think it will, I doubt the economy is going to get overheated in the very, very near term. That allows the Fed to keep the spigot open, so to speak, likely continuing to fall. Few instances where we've seen this. And we combine this with what we know about the economic landscape today. I'd say this is probably from a GDP growth and from an earnings standpoint, this is probably a Q1, maybe a little bit of a Q2, but mostly a first half story. And so I think the market will gyrate around quite a bit in the short term as we start to get a little bit more clarity on just how long this is going to drag. And I think you can bet your bottom dollar, if we get worse headlines in the short term out of Italy, or that this is spread into other core areas like Germany or France, the market's not going to sit well with that. Conversely, if we start to see some data in those other economies that we're seeing out of China, so interestingly enough, last night we got some data out of China showing that it does look like the growth rate of new cases is slowing pretty meaningfully. And we're starting to see some factories get reopened. So at a time when the epicenter for this is actually starting to look a little bit better, now the story is going to be about just how much it might spread. And I know there's a lot of worries, and part of the reason why we're seeing the market react again today is there's a lot of worries that all it takes is one plane flight from Milan to New York, right? I mean, this is kind of the stuff movies are made out of, unfortunately. And I think that's what the market is going to take a little bit more of a wait-and-see attitude towards. The conclusion as an investor, and I'll jump ahead here so we have a little bit of time for Q&A. The conclusion as an investor is, one, we got to focus on those signals. And the signals are going to get a little bit choppy here in the near term as we digest this kind of unknown of just how much this issue is going to spread. but the foundation for this economy, the foundation for corporate profitability still looks pretty good. And the central banks around the world, certainly the Fed, are not at risk of turning the music off anytime soon. We got one other issue the market's got to grapple with beyond coronavirus this year. Anybody know what else might be on deck? That other little thing, the presidential election. Which way is it going to go? I'm asking you, I have no idea. So please feel free to share with me. Does it matter? And I don't mean that, so take that as an apolitical statement. I have no interest in, nor will you hear me make any politically bent statements up here, but I can digest some of this through the lens of what it means for markets. Do you think it matters for the market?
Yes.
Why? A little bit. So it's interesting enough, and I didn't bring the chart with me, but if you go back and you look at, so there's data that tracks consumer confidence. We're all familiar with consumer confidence surveys, right? There's data that tracks it separated by political party. And it's really interesting because you see the two lines crisscross around elections. So if you go back to 2008, you see a crisscross. You go to 2016, you see a crisscross in terms of who's feeling really unconfident and who's feeling really confident. And yet, this is what the market does in the year before and the year after all elections, going back to World War II. So tell me when it was a Democrat and when it was a Republican. Right? Now I say that flippantly. It does matter. Who is in the White House does matter. It matters for policy tone. Lest we forget. Everybody remember 2017? Good year or bad year in the stock market? Really good year in the stock market. Stocks were up 21% and almost never went down that year. The biggest pullback we saw in the stock market for an entire year was 2.8%. Second best in the history of the stock market. Why? Remember what the big catalyst was in 17? Tax reform. The prospects of tax reform. They got the markets excited. So it's not as if presidents don't matter. But what you will find, if you go back over history and look at the data, what you will find is the difference between Republicans and Democrats in the White House in terms of the effect on stock market returns is rather small. We tend to see a lot of the volatility right around the election, but it tends not to persist throughout the entire term. Why? So this is the other issue, right? The thing that we all moan and groan about the most as American citizens is that nothing gets done in Washington. Nothing gets done in Washington. And so the beauty of our democracy is that in many cases what is said on the campaign trail does not necessarily become law or policy. Small parts of it do. There's that old adage that every president kind of gets one big thing, which is somewhat true. But the point is the market's going to look much more beyond that particular policy. It doesn't mean it doesn't matter. And this is again not a political statement, if Bernie Sanders gets the nomination, you're going to see a reaction in the stock market because he doesn't represent a very different approach to capitalism and the stock market. The stock market will probably react in a very knee-jerk reaction around that. This is not something we need to be building long-term financial strategies over. Every one of you in here, I suspect, is an investor. You probably have an investment portfolio. Might be with a handful of the folks that stood up earlier in this room. And I'm assuming that none of you have goals for your portfolio that are perfectly aligned with 4-year presidential terms. Right? Yet that's our natural reaction. Our reaction as investors is to say, coronavirus bad, I've got to do something different with my portfolio. I don't like the way this presidential election is going, I need to do something different with my portfolio. And we have about 100 years worth of data that say that's probably not the best approach to things. Doesn't mean ignore it, but it definitely means you want to try to remove the political filter and the political lens from the investment decisions you're making because the data show us that by and large that's what the market does. It reacts with volatility around those inflection points. Remember what happened the night that Donald Trump got elected? The night of, so the stock market's closed, but there's a market for trading stocks when the market is closed, and the market got absolutely obliterated overnight. So yesterday, down 1,000 points in the Dow, right? It was down 1,000 points the night that Donald Trump got elected, and the Dow was way lower at the time. What did the market do the next day when it opened up? Up. Unpredictable around short periods of time. That's the noise. So as we separate that, the good news is, I think for for us, the way that we see the world, there's still some runway ahead for markets to perform well, but the path is just going to get a lot choppier because some economic issues we're going to have to digest, there's policy and political issues we'll have to digest, and it's not going to be smooth sailing as we navigate that. So let me stop there. Probably trounced all over my time as well, and I want to be respectful because I know you guys have stuff to do. So for anybody that has to go, I take no offense, but if there are any questions, I'd be more than happy to field a few. Is this what you're looking for?
Yep.
Thank you. Hi, I haven't heard this addressed. 70% of GDP is spending money, correct?
Correct.
And how much of that money is spent on product from China that's no longer coming? And will that trigger inflation?
Yeah. Everybody hear the question? So of all that stuff that we're buying, how much of it's coming from China? So Chinese imports into the United States account for about 3% of total global trade value. Now, there is a meaningful amount of that product that's coming in that won't restock shelves. So I'm looking at some data this morning. So we get about 11 million containers. There's a lot of stuff that goes in those containers that come in. This is just some regional data that I was looking at. 11 million containers that come into just the Carolina ports in a year. A lot of that coming from China. It takes a month for those container ships to leave a port in China and get to our eastern seaboard. And those ships are no longer leaving. They're still coming in, they're still showing up today, but there's going to be a gap in between because the ships aren't leaving today. So that's that delayed effect. Because what we're going to see is consumers are going to want, we as consumers are going to want to buy stuff and it's not going to be on the ships. Now, the flip side to that is, unlike in history, if we go back 30 years and something like this would happen, it would grind activity to a consumer activity to a halt because it was much more regional. Today, we can source from other areas. And so one of the knock-on effects, and again, this is not fully baked at this stage, but one of the knock-on effects of, remember the trade war? Remember when we were talking about that all the time? So for 18 months, it was the trade issues going on, the protectionist and tariff issues going on between the US and China. And businesses were reacting, small, medium, and large businesses were reacting by reorienting supply chains. And you probably heard some of this. So supply chains were moving out of China through Vietnam, out of China through South Korea, other areas where they were reorienting supply chains. Now, like I said, that's not fully baked. It's not as if this is not an issue for us anymore, but I think that this is highlighting what businesses were already doing, which is the dependency that the US has developed for the last 20 to 30 years of supply directly from China was a threat that needed to be addressed. And so we're starting to see that evolution. I suspect this will amplify it. So what is it going to mean? Directly to your point. So if we want to spend our 3% raises over the next 6 to 12 months, are we going to be able to buy stuff on the shelves? And the answer to that is probably going to be in some cases no. So Nike's come out and talked about how they'll have a meaningful disruption to inventory and supply. Some of this will be padded over by the fact, again, that if you wanted to buy product X and you would have normally bought it at store Y, you can do that same thing through the internet where it can source from a different warehouse in state Z or in country B, whatever the case might be. So some of that will be buffered by that. I don't think we'll see a totally negligible impact on consumerism. Here would be the point that I would say is probably going to get the most economic impact and market impact. If this bleeds long enough into the summer, it will start to hit holiday inventories. That's still a big portion, not so much in terms of people standing in line on Black Friday, but that's still a huge portion of the retail spend in the country. It would have to take well into June or July before that does start to show up in holiday inventory, but that'll be another point that the markets and we will watch. So all told, we're probably not going to see a meaningful inflationary impact, but we probably will see some inventory impact that will, in some cases, defer purchases. One of the things that we're trying to quantify is how much of consumption in China, and to a much lesser degree here in the United States, is just deferred until supply chains and inventories and consumption get back online, versus completely eradicated. Meaning, if you don't go out to eat, and again, this isn't happening so much in the States, but think about the city lockdowns in China. If you were going to go out to eat on Friday and now your city's locked down and you can't go out, are you going to go out to eat twice when things open back up? Maybe. Who knows? Probably not. On the flip side, if you were going to buy an iPhone in February, and you weren't able to get one because the factories weren't producing enough at the time, are you not going to buy that iPhone in April or May? These are the questions that I have no idea what the answers to them are. We have some history to show us, so we've seen some of these pandemics at much smaller scale. SARS is the one that gets the most press in '03. When that happened, the Chinese economy got decimated. It went from a 10% growth rate to a 5% growth rate, and then the very next quarter went to a 14% growth rate. That is that pent-up demand just being pushed forward. But there was probably some lost consumption in that. That's going to be the question we'll have to answer this time around. How much is lost and how much is just pushed down the line? The more that's pushed down the line, the more this becomes a very temporary factor. Good question, thank you.
Thank you for your presentation. Let's talk about the USMCA trade agreement and the impact that we can anticipate here in Houston.
So, I won't even pretend to know exactly what particular products you're talking about, but I will speak at large about when we look at the impacts of USMCA, NAFTA 2.0, on the trade volumes and relationships that we have with Mexico in particular. So first off, and everybody knows this, right? NAFTA needed to be updated. It was written in the mid-90s. The economy is very different today than it was, and so some of this needed to be updated. The biggest impact is going to come from the rules of origin as it relates to auto parts. So much of this is just small adjustments. You're probably going to see very little impact in terms of the trade between the United States and Canada. Most of this will be the trade between the United States and Mexico, and it's going to require that more auto parts come from areas where the car is fully assembled. Some disruption. I don't think we'll see a meaningful amount when it comes to, and this is perhaps where you're alluding to, a meaningful amount when it comes to commodities trade, in particular natural resource trade. We might see a little bit, but a lot of what USMCA is going to address are the evolutions in technology in the economy. And again, probably the biggest blunt effect of all of this is going to be the impact on the auto industry. How do I think it shakes out? And again, I can only speak from the macroeconomic level. Cars are going to get more expensive. That's what I think is going to happen. I think when you start to encumber and put restrictions around the flow of parts as part of the input to the final product, you start to raise the cost of all those inputs as they relate to the final product. And I think ultimately what we're going to get is inflation in auto sales, or excuse me, in the auto prices. So that's probably a little less detailed than you're hoping for, but that's as we've been looking at USMCA along with a lot of the other trade agreements, phase one of the China deal is kind of a nothing burger. There's an old term. It's kind of a nothing burger as well, right? It's really addressing things that were already in effect. The real trade issues between the U.S. and China relate to technology transfer, intellectual property theft, enforcement, all things that are not addressed in phase one. I would liken that to USMCA, which is its small tweaks to an existing deal as opposed to a meaningful change in the structure of the trade agreement. So see me afterwards if you have some more specific detail. I'll be happy to opine. That's generally our assessment of the trade deal at large.
All right, so once again, I want to thank the sponsors for making today possible. Our presenting sponsor, Edward Jones Investments. Gold sponsors, the Rose and the Mint National Bank. And silver sponsors, Sullivan's Truck Auto and Collision. I hope you guys enjoyed today and got as much out of it as I did. Thank you for attending, and y'all have a great day.